January 23rd, 2026. 6 hours ago, a barrier that held for decades shattered. Silver didn't just cross $100, it exploded to $103. But here's what they're not telling you. While New York celebrates $103, Shanghai just closed at 123. That's a $20 gap. In the same metal, on the same planet, at the same moment. This isn't a pricing error, this is a system fracture, and the banks, they're trapped with losses so catastrophic that closing their positions would only make it worse. What you're about to discover changes everything you thought you knew about money. Welcome to Silver Radar, where we track the signals the mainstream media won't show you. If you've been following global markets for years, if you remember when a dollar actually meant something, then you know the value of staying informed. Do me a favor, would you? Hit that subscribe button right now, not for us, but for yourself. Because what's unfolding in the silver market isn't just news, it's a warning. And we're here to decode it every single day. Also, drop a comment below and let us know, where in the world are you watching this from? Are you in the States, Europe, Asia? We want to know. Because what's happening right now, it's global. Now, let's get into what just happened. They said it couldn't happen. They said $100 was a fantasy, a number that existed only in the fever dreams of conspiracy theorists and doomsday preppers. They said the shorts were covered. The manipulation was over, and the market was finally rational. They lied. It's Friday, January 23rd, 2026, and in the span of less than 6 hours, silver has done something that Wall Street claimed was impossible. It breached 99, and it didn't stop. It didn't pause to consolidate. Didn't give the institutional shorts a moment to regroup. Didn't even acknowledge the psychological significance of triple digits. The market took one look at the round number, laughed, and kept running. Silver is now trading at $103 per ounce. Let that number settle into your consciousness for a moment. 103. This isn't a gradual climb up the stairs of a healthy bull market. This is an elevator with a snapped cable, free falling in reverse, from 99 to 103, a $4 move, a 4% gain, in a single trading session that's supposed to be winding down for the weekend. Traders call this price discovery mode. Economists use softer language, call it volatility or market adjustment, but strip away the jargon, and here's what's actually happening. The anchors have been cut. For 5 decades, silver has been tethered to carefully managed price levels. First the low 20s, then the 30s, then the 50s, then the 80s. Each level held for months, sometimes years, giving everyone a false sense of stability, a false belief that we actually knew what this metal was worth. But today, the final anchor was ripped from the ocean floor, the 99 barrier. The psychological fortress that short sellers defended with billions of dollars is gone. And now the market is floating free. No ceiling above, no floor below, just pure momentum driving the price into territory that hasn't been mapped. Here's what $103 means in the real world. Every solar panel manufacturer, every electronics company, every medical device maker is now paying double what they budgeted for this year. Their entire cost structure obliterated. They face a binary choice now. Pass those costs on to consumers, or go bankrupt trying to absorb them. There is no third option. But the industrial users aren't the ones panicking right now. The real terror, the cold sweat running down spines in corner offices across Wall Street, belongs to the short sellers. If you shorted silver at $80, thinking it would revert to $70, you're now sitting on $23 per ounce in losses. If you're short 10,000 ounces, that's $230,000 in the red. If you're a major bank, a hedge fund, an institution with a 100 million ounce short position, you're down $2.3 billion. That's not a typo. That's not an exaggeration. That's the mathematics of what happens when you bet against a market. And the market decides it's done playing by your rules. And here's the truly diabolical part, the part that turns this from a bad trade into a death spiral. Those losses aren't realized until you close the position. But to close a short position, you have to buy. You have to go into the market and purchase the very metal you promised to deliver. And when you try to buy 100 million ounces in a market that's already running vertically, what do you think happens to the price? It goes higher. Your attempt to stop the bleeding causes more bleeding. Your act of surrender pushes the price further against you. This is the short squeeze mechanism in its purest form. A trap with no exit, the only way out is up. And every tick higher makes the next tick even more inevitable. So when you see $103 on your screen, don't think of it as a destination. Think of it as a mile marker on a highway, where the brakes have failed and the accelerator is stuck to the floor. We're not stopping at $103, we're barely slowing down. But here's what should truly concern anyone paying attention. The move from $99 to $103 wasn't triggered by new information. There was no supply disruption announced at 3 p.m. Eastern. No central bank suddenly declared they were backing their currency with silver. No breaking news that fundamentally changed the equation. This $4 surge, this 4% explosion in 6 hours, is pure momentum, pure fear. The market realizing that the old rules, the old game, the old constraints are gone. And when a market realizes the referees have left the building, when it understands that players can do whatever they want, it enters uncharted territory. It writes its own rules. But the real story, the story that will define the next 48 hours, isn't happening in New York. It's not happening on the COMEX or the Globex. The real story is happening in the one place where physical metal actually changes hands. The real story is happening in Shanghai. And what's unfolding there goes beyond anything the Western financial press is prepared to explain. Because while New York celebrates $103, Shanghai has left the building entirely. If you thought the gap between New York and Shanghai was concerning yesterday, you need to look at your screen right now. Because what's happening in China isn't just unusual. It's unprecedented in modern financial history. While American traders are celebrating silver's breach of $103, while CNBC runs graphics with champagne bottle emojis, while retail investors post rocket ship memes on social media, Shanghai just closed at $123.40 per ounce. Read that number again. $123.40. Not 104s, not 105s, not even 110, $123.40. The gap between New York and Shanghai is no longer $5 or $10 or even the $12 it was yesterday morning. The spread has exploded to $20.40 per ounce. And if you understand what that number represents, you should be concerned, very concerned. In any functioning global market, a $20 price difference in the same commodity should exist for approximately 4.7 seconds. That's how long it takes for high-frequency trading algorithms to detect the discrepancy, execute thousands of trades, and arbitrage the gap back to zero. Buy in the cheap market, sell in the expensive market, pocket the difference. This is Trading 101. This is the invisible mechanism that keeps the price of oil in Texas roughly aligned with the price of oil in Saudi Arabia. The same mechanism that ensures gold in London trades within pennies of gold in Zurich. It's called arbitrage, and it's supposed to be automatic, supposed to be instantaneous, supposed to be impossible to avoid. But it's not working. The algorithms are running, the buy orders are queued, the math is being calculated at microsecond intervals, and nothing is happening. The $20 gap remains. It's not closing, it's widening. Because here's the problem that no amount of computational power can solve. You cannot arbitrage what doesn't exist. You cannot buy silver in New York, ship it to Shanghai, and sell it for a $20 profit. If there is no silver in New York to buy, the Western vaults are empty, or more accurately, what little remains is already spoken for, already allocated, already promised to a dozen different buyers who placed orders weeks ago and are still waiting. This $20.40 spread isn't a profit opportunity, it's a warning siren. It's the market screaming at maximum volume that the Western price, the $103 you see on your Bloomberg terminal, is fiction. It's a number on a screen, a promise, a derivative. But it's not metal, the real price. The price at which actual physical silver changes hands in meaningful quantities is not 103 O's, it's 123 and climbing. Now, let's talk about what this means for the average investor, the person who thinks they can simply log into their brokerage account and click buy silver and acquire metal at $103 because that's what the ticker says. You can't, or rather, you can place the order. The system will accept it. You'll get a confirmation email, but you won't receive metal at that price. Here's what actually happens in practice. You call a dealer. You say, I'd like to purchase 100 ounces of silver at the spot price of $103. The dealer says, absolutely, sir. We can fulfill that order in 6 to 8 weeks. 6 to 8 weeks. Not 6 to 8 days. Not 6 to 8 business hours. 6 to 8 weeks. And here's the beautiful trap embedded in that timeline. In 6 to 8 weeks, when your metal finally arrives, if it arrives, the spot price won't be $103 anymore. It'll be $130 or $150 or $180. And your $103 purchase will look like the deal of the century in hindsight. But you didn't get a deal. You got a delay. You got the promise of silver, not the silver itself. Meanwhile, right now, at this very moment, physical metal is being vacuumed out of every vault in the Western Hemisphere. London, New York, Zurich, Toronto. Bars that sat in storage for decades are being loaded onto cargo planes, and they're all flying in the same direction. East, Shanghai, Hong Kong, Singapore, Mumbai. This is not speculation, this is documented fact. The Shanghai Gold Exchange has reported record trading volumes for 6 consecutive weeks. Not record prices, record volumes. meaning the Chinese aren't just buying because prices are rising, they're buying in quantities that would make Western hedge funds look like amateur hour. And they're not buying because they think silver is going to $150. They're buying because they know the dollar is going to zero. Or more precisely, they know that their government has quietly, without press releases, without fanfare, without official announcements, made it unmistakably clear that precious metals are the only assets that will hold value in the coming currency reset. And when the Chinese government makes something clear, the Chinese people listen. This is not a retail investor panic. This is not Reddit forums coordinating a short squeeze. This is institutional accumulation at a scale that dwarfs anything happening in the West. And the $20 premium they're paying over New York prices, that's not irrational exuberance, that's desperation. Because yesterday the premium was $12. Today it's $20. Tomorrow, if this trajectory continues, it could be $30, it could be $40. And every day they wait, the price gets worse. So they pay. They pay whatever Shanghai demands. They pay in size, they pay in volume. And every purchase pushes the price higher. Every order filled in Shanghai creates a new floor under the global market. Because here's the mathematical reality that cannot be escaped. If Shanghai is paying $123 for silver, and then eventually, inevitably, mechanically, New York has to rise to meet it, the paper market can maintain its illusion for days, maybe weeks, but not forever, not when the physical market is screaming a completely different story. The gap between 103s and 123,000 is not just a price difference. It's the measure of how badly the system is broken. It's the distance between fiction and reality, between promises and metal, between what they say silver is worth and what people will actually pay to possess it. And that distance is growing. 6 hours ago, this was a silver story, a fascinating anomaly in a niche corner of the commodity market, something that precious metals enthusiasts would discuss, while the rest of the financial world went about its business. But that window is closed, because what started in silver is no longer contained to silver. The contagion is spreading. And what we're witnessing now is something far more dangerous than a single metal going parabolic. We're watching the entire financial system begin to crack at the seams. Gold is now trading at $4,987 per ounce. That's a $52 increase since this morning. Now, for those who don't follow precious metals closely, let me put that number in perspective. Gold is supposed to be boring. It's supposed to be the stable one, the predictable one, the asset that moves in $10 or $20 increments over the course of weeks. It's the monetary equivalent of watching paint dry, steady, reliable, safe. A $52 move in a single day, a move exceeding 1%, is not normal. It's not healthy. It's not what happens in a calm market environment. But here's where things get truly bizarre. Here's the detail that should make every economist, every portfolio manager, every central banker stop what they're doing and pay attention. Gold made that $52 move while the stock market was rising. The S&P 500 closed up 0.8%. The Nasdaq closed up 1.1%. The Dow Jones Industrial Average hit a new all-time high, closing above 49,000 for the first time in history. Champagne corks are popping in brokerage firms across Manhattan. Headlines are declaring the bull market unstoppable. Retail investors are checking their 401k balances and smiling. And simultaneously, gold, the ultimate fear asset, the thing people buy when they're terrified, is surging. These two things are not supposed to happen at the same time. They're supposed to be inversely correlated. When stocks rise, gold falls. When gold rises, stocks fall. That's not just conventional wisdom. That's the mathematical foundation of modern portfolio theory. That's the entire reason diversification exists as a concept. But the correlation has snapped. The fundamental law has been repealed. And the reason, the underlying cause that explains both movements simultaneously, is that the denominator is collapsing. When you measure everything in dollars, and the dollar itself is losing credibility, then everything measured in dollars appears to rise. Stocks go up, gold goes up, real estate goes up, commodities go up, not because these assets are becoming more valuable, but because the measuring stick is shrinking. This isn't prosperity, this is monetary decay, disguised as a bull market. Think of it this way. If you're on a sinking ship, and you measure the water level from the deck, it looks like the ocean is rising. But the ocean isn't moving, the ship is sinking. Right now, investors aren't buying stocks because they believe in earnings growth. They're buying stocks because they're fleeing currency. They're not seeking returns. They're seeking refuge. Anywhere. In anything. That isn't cash. Because cash, the one asset that's supposed to be safe, the one thing that's supposed to hold its value, is revealing itself to be the riskiest position of all. And this creates a trap that central banks cannot escape. If they raise interest rates to defend the currency, they crash the economy. Corporate debt becomes unserviceable. Government borrowing costs explode. The housing market implodes. Unemployment spikes. Recession becomes depression. But if they don't raise rates, if they maintain the current policy stance, inflation accelerates. The currency loses credibility even faster. The flight from cash intensifies, and the everything melt-up becomes an everything meltdown. There is no good option here. Every path leads to pain. The only question is, who bears the cost? Savers or debtors? Retirees on fixed incomes? Or homeowners with mortgages? Bondholders? Or equity investors? Someone is going to pay for the decades of monetary expansion. Someone always pays. The bill always comes due. And right now, the market is trying to figure out who gets stuck with it. But let's bring this back to something concrete, something measurable, something that business owners and entrepreneurs can actually prepare for. The banking sector, the institutions that are supposed to be the backbone of financial stability, are sitting on catastrophic exposure, not just to silver shorts, to the entire precious metals complex, to derivatives tied to currency movements, to interest rate swaps that were profitable when rates were zero and are now bleeding billions. Major banks have short positions across gold, silver, platinum, palladium, positions that made sense when metals were range-bound, positions that are now underwater by amounts that dwarf their annual profits. And here's the terrifying part. These aren't just trading losses. These are delivery obligations, contracts that promise physical metal that must be fulfilled regardless of price. When a bank is short 50 million ounces of silver at $80, and the price is now $103, that's not a paper loss they can amortize over quarters. That's metal they have to acquire. Metal they have to deliver, metal that may not exist in sufficient quantities at any price. This is why the Shanghai premium matters. This is why the $20 gap is a systemic warning. Because if the only way to fulfill delivery obligations is to buy at Shanghai prices, then every Western institution with a short position is facing losses that aren't just larger than expected. They're facing losses that threaten solvency. And when solvency comes into question, when counterparty risk enters the conversation, when institutions start wondering if the bank on the other side of their trade can actually perform, markets don't just decline, they freeze, liquidity evaporates, credit markets seize. And what started as a silver story becomes a financial crisis. We're not there yet, but we're closer than most people realize. The cracks are visible, the stress is measurable, the dominoes are lined up. All it takes is one institution, unable to meet a margin call, one fund forced to liquidate positions, one bank admitting it cannot deliver metal it promised, and the cascade begins. This is no longer about silver reaching $103. This is about what $103 silver reveals about the system underneath. The system we've been told is stable, the system we've been assured is resilient, the system that's currently showing unmistakable signs of fracture. Let's strip away the noise. Let's remove the speculation, the fear, the excitement, the disbelief. And let's focus on what actually matters for the people making decisions right now. Business owners, entrepreneurs, investors managing real capital, executives responsible for protecting shareholder value. Because here's the truth that needs to be stated plainly. What's happening in the silver market? What's happening in Shanghai? What's happening across precious metals and equities simultaneously? This isn't entertainment. This isn't a spectacle to watch from the sidelines. This is a strategic inflection point. And how you respond in the next 30 days will determine whether you emerge from this period stronger, or whether you become a case study in what not to do. First, let's address the industrial sector. If your business uses silver in any capacity, your cost structure just changed, not gradually, not predictably, overnight. Solar panel manufacturers, electronics companies, medical device producers, you're now paying double what you budgeted for 2026. That's not a variance you can absorb through operational efficiency. That's not a problem you can solve with better negotiation. You have two options: pass the cost to customers or watch your margins evaporate. And if you're hesitating, if you're thinking you can wait this out, hoping prices will revert, you need to understand something fundamental. Markets don't revert when the underlying structure has changed. They only revert when temporary dislocations correct. What's happening right now is not temporary. The $20 Shanghai premium, the death spiral in short positions, the correlation breakdown across asset classes, these are structural indicators. So if you're in manufacturing, start the conversation with your clients now. Renegotiate contracts, implement cost plus pricing where possible, diversify suppliers, explore alternative materials, because waiting for certainty, waiting for prices to stabilize before acting, that guarantees you'll be making decisions from a position of weakness instead of strength. Now, for portfolio managers and institutional investors, the traditional 60-40 portfolio, 60% equities, 40% bonds, is dead. It died the moment stocks and gold started rising together, because that portfolio structure is built on correlation assumptions that no longer hold. It assumes bonds provide safety when stocks decline. It assumes diversification actually diversifies. But when the currency itself is the variable, when the denominator is unstable, traditional diversification fails. You need to ask yourself a different question now, not what's my equity exposure versus fixed income, but rather, what percentage of my portfolio would survive if the currency lost 30% of its purchasing power in 12 months? Because that's the scenario we're pricing for. That's what the market is telling you, if you're willing to listen. Hard assets deserve a larger allocation than conventional wisdom suggests, not because they're going to outperform, but because they don't have counterparty risk. A bar of silver doesn't promise to pay you. It doesn't depend on another institution's solvency. It exists, and in an environment where promises are breaking, existence matters. Now, let's talk about entrepreneurs and business owners outside the commodity space. You might think this doesn't affect you. You might think silver at $103 is irrelevant to your software company, your consulting firm, your retail operation. You're wrong. Because what's driving silver to $103 is the same force that's about to drive your costs higher across every category. Labor, rent, materials, software subscriptions, everything. When currency credibility erodes, prices don't rise uniformly, they rise chaotically. Some things spike immediately, others lag for months, then catch up violently. Your job, right now, is to identify which of your costs are lagging and prepare for the catch-up. Review your debt structure. If you're carrying variable rate debt and you have the option to lock in fixed rates, do it now. Because if inflation forces central banks to raise rates, your debt service costs will explode. But if you lock in today's rates and inflation continues, your debt becomes cheaper in real terms while your revenues rise in nominal terms. That's the strategic advantage of fixed rate debt in an inflationary environment. Evaluate your pricing power. Can you raise prices without losing customers? If yes, you have a moat. If no, you're exposed. And you need to build that pricing power through differentiation, through value addition, through anything that makes you less substitutable. Because in the next 18 months, businesses without pricing power won't just struggle, they'll disappear. Now, let's discuss timing. Because this is the question everyone is asking. Is it too late? Should I wait for a pullback? What if I buy now and prices drop next week? Here's the framework you need to understand. In markets like this, there are two types of mistakes: being too early and being too late. If you're too early, you suffer opportunity cost. You tie up capital that could have earned returns elsewhere. You watch the market drift sideways or down while you hold positions. It's frustrating, it's psychologically difficult, but it's survivable. If you're too late, you miss the opportunity entirely. You watch from the sidelines as prices leave you behind. You enter at significantly worse levels, or you don't enter at all, and that's not just frustrating, that's permanent. In asymmetric risk environments, where downside is limited but upside is uncapped, the cost of being too late far exceeds the cost of being too early. So the question isn't, what's the perfect entry point? The question is, what's my threshold for acceptable regret? If you can live with buying at $103 and watching it dip to $95 next month before continuing higher, then act now. If you can't live with that, if that volatility would cause you to panic and sell at the bottom, then you're not ready, and that's fine. Just understand, you're choosing comfort over opportunity. Now, let's talk about what to watch. The early warning indicators that will tell you whether this accelerates or stabilizes. First, the Shanghai premium. If it widens from $20 to $30, then $40, that tells you the physical shortage is intensifying. That tells you Western vaults are emptying faster than they can be refilled. That tells you the paper market is losing credibility. Second, the gold to silver ratio. Historically, silver outperforms gold in the late stages of precious metals bull markets. The ratio compresses. If gold is at $5,000 and silver is at $100, that's a ratio of 48.5 to 1. If that ratio drops to 40, then 35, then 30. It means silver is playing catch-up. It means the industrial demand story is converging with the monetary demand story. Third, currency cross rates. Watch the dollar index. Watch euro dollar. Watch yuan dollar. Because if those start moving violently, if currency volatility spikes, that's confirmation that this isn't just about precious metals. It's about fiat currency credibility. And that changes everything. Fourth, bond yields. If yields spike, If the 10-year Treasury suddenly jumps from 4.5% to 5.5%, that's the market pricing in either inflation expectations or credit risk, or both. Either scenario is catastrophic for the existing system. And finally, watch for government response, because governments don't sit idle when assets they don't control start outperforming assets they do control. History is full of examples. Executive Orders 6102 in 1933, confiscating gold, Nixon closing the gold window in 1971, capital controls in Cyprus in 2013. When the stakes get high enough, when the system is threatened, governments act. And those actions are rarely investor-friendly. So if you're positioning in hard assets, understand the regulatory risk, diversify jurisdictions, consider legal structures that provide protection. Don't concentrate everything in one location, one account, one custodian. Because the biggest risk isn't that silver goes to $80. The biggest risk is that it goes to $200 and governments decide you're not allowed to own it anymore. Let's bring this to a close with the perspective that matters most. This is not about silver. Silver is the symptom. The disease is currency debasement. The disease is 50 years of monetary expansion with no anchor. The disease is a system built on the assumption that debt doesn't matter, that deficits don't matter, that consequences can be perpetually deferred. $103 silver is just the market's way of saying the bill is due, the deferral is over, the consequences have arrived, and they're not going to be contained to a single metal, or a single market, or a single country. This is global. This is systemic. This is the moment when decades of policy decisions reach their mathematical limit. No one can predict the exact path forward. No one knows if silver hits $150 next month, or $80. No one knows if this ends in hyperinflation, or deflationary collapse, or some hybrid scenario that economics textbooks don't have a name for yet. But here's what we do know. The people who understand what's happening have an advantage over those who don't. The people who prepare will fare better than those who don't. And the cost of prudent preparation is infinitely less than the cost of complacency. So as you watch silver trade at $103, as you watch Shanghai surge to $123, as you watch the banks trapped in positions they can't escape, ask yourself one question. What does your business, your portfolio, your financial life look like if this continues? And if you don't like the answer, start building a different answer. Today, not next week, not after you see more data, not after you achieve certainty. Because in markets like this, certainty is the luxury you pay the most for, and by the time you have it, it's already too late.